Okay, Maneesh Dangi is also ready, and Manish and me have argued from about 18 months now the template which he's been indicating to our viewers that yields will go higher, crude will go higher, equities will come down. And for a change, I wish Manish Dangi, you got the template wrong. But kudos to you, you got the template right. I mean, getting a bearish template right sometimes means that it's pain for investors, but markets are markets. They work on reality, not so much on expectations.
Yeah, it's basically, I think of markets, and like many who think of markets as, the time there is more important than timing. It's just another frame of actually looking at things, in in the setup that we live in, there are cycles, and you know folks like us, could potentially play cycles. So I mean, there was a great upcycle from March 2020 that we discussed many times until July, August of 2021, and it's reversing precisely for the reasons that we've been discussing for last 6-7 months.
Manish, 2021 was the reflation trade, the comeback trade, small and mid cap stocks, which you pointed out. 2021 or the second half of 2021 was about uptick in inflation and uptick in bond yields. What is the cycle which will be at play for the remaining part of 2022?
So basically, why do interest rates go up? They go up because one, of course, central bankers and other policymakers are not supportive of low rates actually driving more growth. So to a certain extent, growth has returned, which is a reasonable narrative, and which is why many of your guests, when they argue that, including the famous ones, that tight rates are actually reflective of strong economy, the small nuance of the macro that they don't get right, I think, is that when the interest rates go up for not for the reasons of growth, but for something else, which is inflation, it's not actually good. So November markets were actually in equance pricing one rate hike in US, and now we are pricing 6-7. So that flip is why markets are puking. So my sense is that I think rate story is pretty much, I mean, I don't think the surprise that I was anticipating, and the fact that, I thought markets were wrong in not pricing rate hike, I can't argue that anymore. Markets are pricing rate hikes. Now what we have to wonder as to these rate hikes, to tame inflation, what are the side effects of it? Because this is happening when actually global economy is actually slowing, including that of India. So you are hiking rates not for the benevolent reasons that many folks talk of, that the growth is growing, so therefore we must hike rate. No, growth is actually slowing, and yet we are actually pricking because something seems to be troubling us, which is inflation. Same thing for oil, because oil goes up for reasons like demand supply. If demand is very high, then of course oil should go up. But then after a long time, and since 2014, it's actually the supply. That's the point I've been saying for the last 6-7 months. And there is a crescendo ahead. That's the supply which is driving oil price, not Russia, Ukraine, and not geopolitics, and not demand. It's a supply, and that's still in play, unfortunately. So both of them, will only reverse when they actually do the damage that they are out there to do, which is slow the economy very, very sharply. And you're not going to like, as far as risk markets are concerned, we've discussed about it many times. You're not going to like this.
Well, Dr. Fisher-Aki also made this excellent point that it's not the demand, it's the supply. OPEC is almost running full capacity. The taps are almost running at full capacity. So, yeah. Manish, let's work with what you just flagged off. High inflation, low demand. Now, what we learned in our college was a word called hyperinflation, and that's bad news. So what does one do? Because bond prices will remain high, equity prices will remain low. So what should be the asset allocation, and what should an investor do? While in India, you can say that I'm making a 5% FD, but that is not what the objective is. So what are you telling your clients? Is it about taking that hard bite bullet and say I'm going to put money in FD, or you can find some correlations for us in terms of asset classes changes?
No, I mean, 5 is not option. You're getting now 10-year bond at 7%. A good PSU bonds, 10-year bonds are available at 7%. They will very soon be at 7.5 maybe. So, it's not that bad, Nikunj, anymore. You're not in that setup which you were there 6-8 months ago, that no rates are so low. So therefore, I have no other option. And you have reasonable interest rates instrument available. You don't have to go to fixed deposits, of course, and they will also rise as we move forward. So when the transitions take place, such as what we are seeing for the last 4-5 months, I think it's best to be in cash. You don't have to necessarily be in some long-term asset allocation where you are sort of stuck for 3-4 years. At times it makes sense to be sitting on dry cash, because neither fixed income nor equity offer you opportunity. Because cash is an optionality, Nikunj. And if you sit out, let's say if you sat out for last 4 months, you suddenly have 100 basis point wider interest rates and of course now sharply lower small caps and mid caps. You still most probably should wait out, okay, but earn just, let's say in cash, you're earning 5-6% right now in some, arbitrage funds and liquid funds, 4.5-5%, some savings deposits or small finance banks will give you 6-7% also. So, stay there for a while. You'll get good opportunity either in bond or equity. More likely bond, because equity, I think, the flush is still, is some time away. It's like what we are saying is not the final flush. I think the flush is still some time away, because there are far too many people, who actually believing that India's time has come and, now equity is what is going to make them rich. It doesn't happen like that. So I think only after that flush, is when you should enter equities.
I must share with our viewers that Maneesh has been very vocal about why yields will go higher. I would nod my head, because in a bull market somebody comes out and says that, look, equity markets will go through a pain and yields will go higher. So I must admit that I did not believe his thesis, but it's been a great analysis by you. So Maneesh, I'm going to ask this question perhaps for a larger audience. We'll try and make this as part of our money show also. 2 questions. One, is it time now to, let's say, get out of fixed deposit and buy government bonds? Because in fixed deposit, 5%, 4.5% is what you get. Government bonds are giving you 7%. And second, why is that in India the government bonds are at almost 7% and home loans are at 6.5 or 6.6%? Because ideally, government is giving you more interest than what your banks are charging you.
Home loan is there's a plot there. Basically it's like those offers which are made to you that you come in first and then we'll charge you later. So these are floating rates. You're not going to through your lifetime, you're not going to experience the rates that you're getting. It's a bait, that you want, that the bank is offering you near-term rates very low, but eventually they all are linked to broader rate structures and they'll be reset higher. So I think it's a 10-year bond and a repo linked, home loan. There's an unfair competition or comparison. I think home loan rates will, for your life, typically you would hold a home loan for 8-9 years. You're very likely to experience a net 8.5-9% instead of 6.5%, because that's a very short-term thing. On fixed deposit, my point is same, Nikunj, that wait out with cash right now. As I said in the beginning itself, that there is a way to earn 5-6%. So just sort of let your money do some basic plumbing and don't look for locking your money for long term, because most probably in next 5-6 months you will get opportunity to lock your money either in a 7.5-8% bond or potentially a 12% CAGR in equity again, when sort of final flush happens. Either of them, you will have an opportunity to dial. Until then, just sort of stay out. Is a cycle call. Now, of course, many people can't do this, which is the point I make, that I am very clear for the last 5-6 months, stay out of small caps and mid caps, because there is a lot of illiquidity and there is a lot of froth built in there. But if you are a perennial forever investor, then yeah, I mean Nifty or Nifty-like assets are a fair play. Stay invested there passively. But if you're an incremental asset allocator guy, then it's best to sort of wait out.
Put those flashes out also as to what Manish feels that why cash is king. Manish Dangi, appreciate your time. Thank you for joining us.